Welcome to Talk Tickers. If you're here for the core insights from the latest earnings calls, without all the fluff, then you've definitely come to the right place.
Yeah, today we're digging into BuildDirect's Q1 2025 results. This covers the conference call for the 3 months ending March 31st, 2025.
And our goal, as always, for you experienced investors out there is really to cut through the noise and get straight to what matters. The key figures, the strategy, what management's emphasizing.
Exactly. We'll kick off with a quick snapshot of the quarter's performance, and then we'll get into the financial nitty-gritty, look at the strategic stuff they talked about, and wrap things up with maybe a bit of speculative thinking based on what we heard.
All right, let's get right into it then. So top line numbers for Q1 2025. BuildDirect reported revenue of $15.1 million.
And gross margin landed at 41.3%.
Okay, and adjusted EBITDA.
That came in around $650,000.
So how does that stack up against the same time last year, Q1 2024?
Well, comparing to Q1 24, revenue was actually down slightly this year. So $15.1 million versus $15.6 million last year.
Okay, a small dip.
But the gross margin was noticeably better. 41.3% this quarter compared to 39.1% a year ago. That's a good jump.
And adjusted EBITDA saw a nice lift too then.
Absolutely. It improved from just over $500,000 in Q1 24 up to that $650,000 figure this quarter.
Interesting. So even with slightly less revenue, they managed to boost profitability. More bang for their buck, essentially.
Yeah, exactly. It shows better operational leverage, generating more adjusted profit from slightly fewer sales.
Okay, let's unpack that revenue dip then. It was about $500,000 or 3.2%. Where did that softness actually come from?
So looking at the segments, their e-commerce revenue was pretty much flat year over year, just a tiny 1% decrease, $4.2 million this quarter versus $4.3 million last year.
Right, so the main hit was in the Pro Centers.
That's right. That's where the bigger shift was. Pro Centers revenue came in at $10.8 million, which is down about $450,000 or 4% from $11.3 million in Q1 2024.
And did management give a reason for that? Seems pretty specific.
They did, yeah. They pointed fingers squarely at bad weather, especially in their key Michigan markets back in January and February.
Oh, okay.
So it really hurt foot traffic and, delayed project starts, pushing them later in the quarter or maybe even into Q2.
Okay, so revenue down a bit due to weather, but then gross profit actually went up. How'd they manage that?
Yeah, this is where the story gets pretty interesting. Gross profit actually climbed by $133,000, about 2.2%, hitting $6.2 million compared to $6.1 million last year.
And that margin expansion, 220 basis points, that's not insignificant.
Not at all. It's quite solid. The reason they cited was basically a better sales mix. They pushed more of their higher margin core inventory across both e-commerce and the Pro Centers.
So good inventory management, maybe some pricing power?
Seems like it. Definitely shows they were effective there.
Okay, moving down the P&L. Operating expenses, OPEX, what happened there?
Total OPEX was actually down slightly overall, just $28,000 lower, landing at $6.4 million. But the real story kind of hidden within OPEX was fulfillment costs.
Oh, yeah. What about them?
They dropped by $102,000. That's over 10%. Came in just under $900K compared to $1 million last year.
Wow. Okay. That sounds like a big win on fulfillment. What drove that?
Well, it's tied directly to a pretty major operational change they made. They said it was partly due to slightly lower e-commerce volume, sure, but the bigger piece was cost savings they negotiated with vendors.
Okay.
As part of their move away from using a third-party logistics provider, that 3PL transition.
Right. You mentioned we'd talk about that. So we're seeing the financial impact already.
Exactly. It's showing up right here in the numbers. Elsewhere in OPEX, selling and marketing costs pick up a bit by $53,000 to $1.4 million. Probably investing for growth,
Makes sense.
And admin costs were basically flat, up just 0.3% to $3.2 million. But management did say they expect some cost-cutting initiatives they finished in Q1 to start helping that admin line going forward.
Okay. Below operating income, anything noteworthy in other income or expenses?
Yeah, a couple of things. Interest expense was up by $19,000 to $349,000. They said that's mainly higher accrued interest on some insider loans and also interest kicking in on their new credit facility with Royal Bank.
Okay. And there was something about warrants.
Yeah, a non-cash loss of $131,000 from a fair value warrant adjustment. That compares to a small gain of $3,000 last year.
Right. Can you just quickly explain that warrant adjustment again? Why a loss?
Sure. It's really just an accounting thing. It's non-cash. It happens because the company's share price went up during the quarter, Warrants are treated as liabilities, so when the stock price rises, the value of that liability goes up on paper, creating a non-cash expense. Doesn't actually affect their operating cash flow.
Got it. Non-cash accounting. Anything else?
Yes. They also booked about $120,000 in restructuring costs in Q1. Last year, there were none. This was mainly severance tied to some headcount reductions they did as part of streamlining operations.
So a one-time hit this quarter?
Seems like it.
Okay, so let's tie it all back to Adjusted EBITDA. $650,000 this quarter, up from just over $500 last year. What were the main things pushing that $150,000 improvement?
It really boils down to those stronger gross margins we talked about, plus adding back those one-time restructuring costs. It shows the underlying business is performing better operationally, even with those slight revenue headwinds.
Makes sense. How's the balance sheet looking? What was their financial footing like at the end of March?
They painted a picture of a strong balance sheet. Current assets were $16.6 million, which comfortably covered current liabilities of $14 million. That leaves them with a cushion of $2.5 million.
And the current ratio?
Works out to a solid 1.2 times.
Now, that $14 million in current liabilities, does that include their bank debt?
It does. About $2.4 million of that is bank debt from their line of credit.
Yeah.
Now, accounting rules classify demand loans like that as current.
Right.
But management made a point of saying that, practically speaking, their bank partner isn't expecting repayment within the next 12 months. So while it looks current on paper, it's not seen as an immediate cash crunch.
And their actual cash on hand?
Strong. $3.5 million at quarter end, which was $1.2 million higher than the same point last year.
Okay, good position there. What about cash flow during the quarter itself, operations?
Cash from operations actually brought in $768,000 in Q1 25. That was down a bit from $1.2 million in the prior year, so a decrease of about $400,000.
Any reason given for that drop in operating cash flow?
Yeah, they said it was mostly because of a smaller positive contribution from non-cash working capital changes. Things like inventory, receivables. Last year, those changes gave them a bigger cash inflow boost, about $665K positive compared to this quarter, which was only about $313K positive.
So not necessarily a bad sign, just less of a tailwind from working capital this time around.
Exactly, just something to note. Cash used in investing activities was $101,000. Last year, investing actually provided $41,000.
Okay, what caused that swing?
Mostly higher spending on property, plant, and equipment, PPE. Likely for those new pro centers they're opening. Plus, they received less cash from some subleases that matured last year.
Right, and financing activities. That was a pretty wild swing, wasn't it? Injecting cash this year versus using cash last year?
Huge swing, yeah. Cash provided by financing was $476,000 this quarter. Compare that to $1.7 million used in Q1 2024. That's a $2.1 million difference.
Wow, what explains that?
Mostly boils down to drawing on their credit facility this year. They took advances of $1.2 million, mainly to fund that Florida Pro Center acquisition we'll talk about. They didn't do that last year. Plus, they didn't have any deferred consideration or loan repayments this Q1 like they did in Q1 24. So yeah, reflects funding growth via that new credit line.
Okay, shifting gears from the pure numbers. Management seemed to spend a good chunk of time talking about their strategy moving forward. What are the sort of main pillars there?
Yeah, their focus sounds pretty consistent, really. They want to keep strengthening profitability, drive growth especially by expanding that physical store network. The pro centers accelerate the high-margin e-commerce side, find more operational efficiencies, and, ultimately create long-term value for shareholders.
Standard stuff, but important. And they did point to some actual progress on these fronts, right? Both in Q1 and just after.
Oh, absolutely. On the expansion side, the big news was completing that acquisition in Florida back in March. They picked up key assets from a company called Anchor York Flooring in Orlando.
Right, the Florida deal.
Yeah, it cost about $593,000 US. It's a big step for them into the Southeast US market, which they see as really important strategically.
And wasn't there also a new pro center opening on the West Coast?
Correct. New one opened in Southern California, boosting their presence out there too.
Okay, and operationally, you mentioned that big logistics change, getting out of the third-party providers.
Yes, that was another major achievement they highlighted. They finished transitioning out of their 3PLs and into their own fully owned and operated facility.
Okay, you flagged this earlier with the fulfillment costs. Tell us a bit more about why this is such a big deal for them.
Well, they framed it as pretty significant. It lets them enhance their direct-to-pro service, strengthens their West Coast operations generally, and crucially, they emphasized how it's already brought down fulfillment costs quite remarkably, which, lines up with the Q1 numbers we saw.
Better service too, presumably.
Apparently so. They mentioned improved customer service and noted significantly lower claim rates since they made the switch. So cost savings and better service, that's a win-win.
Definitely.
And on top of that, they also talked about moving forward with other operational streamlining initiatives during Q1. They expect those to generate roughly $900,000 US in annualized savings.
So separate savings from the fulfillment piece.
Yeah, seems like additional cost efficiencies they found. Adds to the overall picture.
Got it. Were there any major events mentioned that happened after Q1 closed, subsequent events?
Yes, two key ones. First, and this sounds potentially huge, they signed a supply agreement on April 23rd. It's worth up to $200 million US.
200 million, wow.
Yeah, massive number. It's with a large North American customer in the sports, entertainment, and recreation sector. BuildDirect's high-performance flooring will be used.
Okay, so that really plants their flag in the high-spec commercial space.
Exactly. Reinforces their position there. Management noted their model works for both, small home jobs and these giant projects.
Interesting flexibility. What was the other subsequent event?
The other one was a related party transaction. They completed a secured loan with an insider, a group called Growth Partners, for $775,000 US.
Okay, and what was that loan for?
The funds were specifically used by senior executives at BuildDirect to purchase company shares privately.
Ah, so management buying more stock.
Right. From BuildDirect's balance sheet view, it's kind of a wash. They have a loan payable to Growth Partners, but also a loan receivable from the management team. So it's net neutral, doesn't add leverage to the company itself.
But the key takeaway for investors
is that it significantly boosts management's ownership stake. More skin in the game, aligning their incentives with shareholders. That's usually seen as a positive signal.
Okay, good context. Let's circle back to M&A. It sounds absolutely central to their growth story this year. What exactly are they looking for when they acquire companies?
Yeah, they laid out a pretty clear framework. They're targeting locations that are, say, underutilized or maybe underperforming, which they can quickly convert into their Pro Center model. High ROI potential and minimal disruption are key.
What about the financial criteria? Any specifics there?
Definitely. They emphasized needing a validated book value, basically making sure there are real assets backing the price, giving them downside protection. They want businesses with a clear path to hitting positive EBITDA within a 12 to 24-month payback period based on a conservative plan.
So quick returns are important.
Seems so. And of course, it needs to fit geographically and logistically with their network. Crucially, they need to see clear synergy potential, how they can quickly plug in their centralized buying power, marketing, distribution, and make the acquired business better.
Right, make it accretive and relatively low risk. Let's apply that to the Encore York deal in Florida. Did they give more specifics on that one?
They did. That deal value, around $590K US, they noted, was roughly 1 times the target's EBITDA. So attractive multiple. What they got was an established business with existing relationships with local builders, an immediate inventory footprint in Florida, and importantly, a proven operational team.
Did they mention Encore York's prior performance?
Yeah, they said the acquired business had previous unaudited financials showing about $5.8 million in revenue and roughly $661,000 in EBITDA.
Okay. And how's the integration going? Did they comment on that?
They described it as fast, said it's essentially done already, felt they had a good process ready. They expect the benefits, like pushing their own products and marketing, to really show up in that unit's results in Q3 and Q4.
Any synergies flowing back to the main BuildDirect business?
Yeah, they highlighted a couple. Encore York gives them a better entry point into specific commercial sectors like medical and hospitality areas.
Yeah.
BuildDirect wasn't as strong in. That offers cross-selling potential. Plus, they mentioned getting substantial freight savings now that they can ship from that Florida location.
Makes sense. In the Q&A part of the call, did they talk more about the expansion pipeline?
They did. Management said the M&A pipeline is healthy. They're actively looking at deals. They even put a number out there potentially adding $15 million to $20 million in annualized revenue this year through acquisitions.
Okay, and Encore York was about $6 million of that.
Right. So that leaves, maybe another $9 million to $14 million in acquired revenue they're still hunting for this year.
Any preference on timing for those potential deals?
Ideally, they said they'd like deals to close in Q3, allowing Q4 for integration. But they were pretty firm that they won't force a deal just to meet a deadline. It has to be the right fit, the right kind of deal.
They also discussed why they tend to prefer buying versus building from scratch, right?
Yeah, they see acquisition as generally easier and having a faster payback. A huge factor is getting an established team. They call that the most important part, especially if the previous owners aren't running it day to day anymore.
Lets them plug in their systems faster.
Exactly. They can quickly bring in their procurement, marketing, etc., and see rapid improvements.
Yeah.
Pointed to Angkor York as proof it works. They also mentioned the flooring industry is super fragmented, like over 12,000 independent operators. So plenty of targets, but finding the right one is key.
How about getting deeper into that commercial segment? Angkor York helps, but what's the broader strategy?
They said they're already in commercial, but yeah, Angkor helps them get into specific subsectors. Their main focus seems to be on product fulfillment, basically acting as the direct source from the factory to the job site.
Right, and the margins on that kind of commercial fulfillment work.
They describe them as fantastic, much better, they implied, than the margins often associated with actually doing the installation,
Right.
which they leave to the general contractor. That huge supply contract win they announced, they held that up as a prime example of this high-margin product fulfillment model in action.
Gotcha. Lastly, guidance and seasonality. Did they give any firm targets for 2025?
No formal financial guidance for the full year. The main reason they gave was the M&A strategy. The timing of those potentially big accretive deals is just too unpredictable.
So how should we measure their success this year then?
They basically suggested looking at the amount of revenue they managed to acquire, pointing back to that $15–20 million target range.
Okay. And seasonality, what's the typical pattern?
They noted the back half of Q4 and Q1 tend to be softer. If you were trying to normalize things, you might think of Q1 as being roughly 20% weaker than the peak Q2 and Q3 periods.
And Q1 this year had those specific weather issues in Michigan too.
Right, plus maybe some noise around the auto industry there. But they did add that seasonality is much milder in markets like the Southeast, Southwest, and the West Coast, which conveniently is where they're focusing their expansion efforts.
Okay, that pretty much covers the key performance points and strategic updates from the call. We've been dissecting BuildDirect's Q1 2025 results and management's commentary.
Right. And now, purely as a thought exercise, let's put on our speculative thinking caps for a moment. Based only on what was said in the call, how might someone brainstorm some potential upside scenarios?
And let's be crystal clear here. This is Talk Tickers, and what comes next is absolutely positively not financial advice. We're just playing what if, based solely on the public info from this one earnings call. Please do not trade or invest based on this. Investing carries significant risk.
Okay, disclaimer fully noted. All right, here's one angle. Let's call it trade idea number one, the M&A plus savings hockey stick bet.
Intriguing name. Okay, what's the pitch?
The pitch is, maybe consider an aggressive long position in Build stock. The thesis is the market might be seriously underestimating the combined punch of a few things they discussed.
Okay, break it down.
Right. So factor one, management's stated goal of adding $15–20 million in revenue via M&A this year. $6 million is already in the bag with Angkor York, leaving $9–14 million more potentially coming. And they're billing these at attractive, roughly 1x EBITDA multiples.
Okay, accretive M&A potential. What else?
Factor two, that 900,000 US years in annualized operational savings they're executing on. Factor three, the remarkable fulfillment cost savings they've already achieved by ditching the 3PLs. Factor four, the fantastic margins they're getting in that growing commercial product fulfillment segment.
Okay, so stacking up multiple potential tailwinds, what's the rationale for why this leads to a hockey stick?
The rationale is if they manage to close even a decent chunk of that remaining M&A target in, say, Q3 or Q4, and those cost savings really at the bottom line, you could see a pretty dramatic inflection point in Adjusted EBITDA in the back half of 25 and into early 26.
And that accelerating earnings growth could lead to?
Could lead to significant multiple expansion on the stock, meaning the price could move much higher, much faster than maybe current expectations imply.
Okay. Outrageous or plausible?
Well, it feels a bit outrageous because pinning down M&A timing is always tricky, and integration always has risks. Plus, realizing the full extent of savings isn't guaranteed. But it feels plausible because management sounded pretty confident about the M&A pipeline, the cost initiatives are real, the 3PL exit is done, and they explicitly highlighted the commercial margin strength. The pieces are there.
All right. Trade idea number two.
Let's call this one the supply agreement catalyst bet.
Okay, different angle. What's the pitch here?
Pitch. Maybe look at buying some out-of-the-money call options on Build, but with a longer expiration date, maybe 12, even 18 months out. This isn't about Q1 results at all. It's a pure bet on that massive future catalyst they mentioned.
You're talking about that $200 million supply agreement again.
Exactly. That contract is potentially enormous compared to BuildDirect's current size. Now, huge caveat, they gave zero timeline for when revenue might actually start flowing from that deal, and it's up to $200 million, not guaranteed.
Right. Big unknowns.
Huge unknowns. But if and when revenue from a deal that size does start hitting the books, especially in that high-margin commercial segment they talked about, it could cause a step-change increase in their revenue and profit profile, something the market almost certainly isn't pricing in right now.
And that surprise factor could cause a rapid jump in the stock price.
That's the theoretical play. The sheer scale makes it potentially transformative if it comes through. Outrageous or plausible?
Feels pretty outrageous because the timing is a complete black box, the actual revenue realized is unknown, and buying OTM calls is inherently speculative and high risk. Loses value fast if you're wrong on timing.
Totally agree on the risks. But it's plausible because a contract that big simply will move the needle dramatically if it contributes significantly. And management wouldn't have highlighted it as a key subsequent event if it wasn't potentially very meaningful.
Okay. So 2 speculative ideas, definitely not advice. Good thought exercise, though.
Absolutely. Again, purely hypothetical based on the call commentary.
So wrapping up our deep dive on BuildDirect's Q1 2025 call, the story seems to be revenue down slightly due to some external headwinds like weather, but strong execution internally led to better gross margins and continued positive adjusted EBITDA.
Yeah, underpinned by some significant strategic moves.
Yeah.
The Anchor York acquisition, boosting their Florida presence, the new California Pro Center, that really important 3PL transition completion, and progress on broader cost savings.
And looking ahead, it's all about leveraging those operational gains, pushing hard on accretive M&A to scale up, and then there's that potential wild card of the massive new commercial supply agreement waiting in the wings.
Exactly. Yeah. That seems to be the narrative coming out of the call. Yeah. And just to reiterate, our entire discussion today was based solely on the information presented during that specific earnings call.
And one last time for the people in the back, this is not financial advice.
Definitely not.
We hope this breakdown gave you some valuable insights into BuildDirect's recent performance and outlook. If you have thoughts on BuildDirect or maybe another earnings call you'd like us to tackle, feel free to reach out.